So once again, I think so. Let's start the session. So today we have this is the second last chapter of your model one you are taking. That is some multiple issues from the taxation point of view to understand. This is the chapter 25, international tax and frauds, and some terms like GAAR, BEPS, right? So POM, and this I think we will going to understand through this chapter, because again they are related to the how the fraud is being now like committed by the industry through misusing the taxation laws, right? So taxation now they're very important. So they're like they are doing all this. So it is basically to prevent the tax and provisions misuse and thus avoiding the taxation. This has been the core point. So where the government is defrauded by the like unscrupulous businessman. So this is what is the point we need to understand. So internationally, these things are happening basically, as far as understand by various provisions and issues. So first and foremost, of course, GAAR, which many of you may be aware, I think, General Anti-Avoidance Rule, very critical. Like this has been implemented by the government somewhere in around 2017. Basically, it's to curb and avoid tax leaks. So, General Anti-Avoidance Rule, basically GAAR, and is a tool for basically to check aggressive tax planning, where people through the tax planning try to subvert the taxation and other aspect and some other business by making some business arrangement or by entering into some kind of a ways to avoid tax basically, right? So this has come like a very important measure, the GAAR. So it's basically aimed to cut revenue losses that happen to the government due to the aggressive tax avoidance measures practiced by the companies basically, right? And we see in the Vodafone case, I think many of you must be aware how the sale of the transfer basically and of shares, transfer of the entity and the sale of shares, the capital gain tax ultimately has been avoided now by the now this in the Vodafone group case basically. It's quite a long battle government has to do, but ultimately like in the international court they lost it also. So let us understand some terms: tax evasion, tax avoidance, and tax mitigation, right? So see, the tax evasion very clearly has an aspect of illegality, where entity does not pay taxes to the government, and which is illegal. So you can say it as a like illegality, willful suppression of fact, misrepresentation, fraud, all constitute tax evasion basically, right? So you use illegal means to essentially avoid taxes, or you suppress the fact you earn something you are not disclosing. You are shifting your business to the some tax haven zones, like we have many tax haven zones in the world basically, now where the corporate shift their offices, and based on that the the taxes are being avoided basically, right? Or you misrepresent certain facts basically. We'll discuss all these things. So multiple ways are there. The taxes are avoided by the law basically. It's called tax evasion. Yeah. Then similar to that, we have a tax avoidance. Tax avoidance basically. Please mute. I think. May I request you? If somebody is on the unmute, I think. Kindly mute yourself. Yeah. Thank you so much. So tax avoidance, my dear friend, is a again action by the taxpayer. Like, of course, they may not be illegal. Like they may not be illegal, right? Or forbidden the law, but still, like they are considered undesirable, inequitable, right? Because they ultimately defeat the very objective of the revenue, basically, right? So, but they are not illegal. So within that, they plan. It's called tax avoidance, right? So, like somebody creating a Hindu and family trust, somebody create. So they are not illegal, basically, right? But you avoid the taxes by creating these kind of parallel identities, and it is, I think, that is where the government keeps strengthening the laws, right, to ensure there are no illegal, there are no ways are there, basically there are genuine ways are there, but there are no ways to you can see which undermine the objective of the revenue. So we there's a very thin line between the tax avoidance, like in this case, and the tax evasion. Tax evasion is totally illegal, but tax avoidance is not illegal. It is basically you plan the taxes very smartly, right? But still they are undesirable, inequitable, right? They are not very nice ways, basically, like by the government. So that is where they now go for these additional measures to see this revenue is not leaked, basically. Like I give example of, you create a HUF, you have your income, you create one more at one HUF. And HUF, you can create number of HUF, you can create Hindu and Devana family, and you divert income to that. So it is not illegal, but it is certainly not desirable, right? So and then this is what is the point. And then, of course, tax mitigation is a basically a situation where taxpayer take advantage of fiscal incentive provided by the government. So that is fine. I think you, like we have many time government give a giving exemption to the small scale industry, to the this newly set up industry. They give a this benefit industrial, they give a benefit to establish the unit in the certain industrial hubs, basically. So there are, so that is, of course, is a government giving an incentive. You use it for your for that, and there is no problem in that. So these are terms we need to understand. Little interestingly, these terms are there where this is we need to take care of these things, right? Okay. So going further, let's now, in this case, where we need to take care of that. Yeah, let's go further. Now, what is the GAAR, basically, right? So GAAR is would apply to arrangement entered by the taxpayer which may be declared to be impermissible avoidance agreement. So GAAR is applicable where you made some arrangement and government declare this is IAA, impermissible avoidance agreement, right? Very clear. Now what is that IAA? Let's understand as where the GAAR will become applicable. So the GAAR provision applicable to the impermissible avoidance agreement. What is that? If two conditions are satisfied, the main purpose of entering such arrangement is to obtain tax benefit, right? And if the arrangement creates rights, obligations, which are not ordinarily created between the person dealing at the arm's length. Arm's length, you must be, I think, must be knowing, you should deal with a, normal dealings are arm's length dealing. Like I am selling to somebody, I'm buying from somebody, and there is proper commercial term. But if I deal with somebody, a known person, maybe my relative or somewhere, and that because of the proximity, I take advantage. That is where the dealing is not arm's length, basically. So that's called where you take advantage. Like suppose you purchase a goods from an entity which is owned by you can say indirectly controlled by you, and in that you in that case you buy at a higher prices to shoot down the profits. That is the dealing not at arm's length, because I'm using that proximity, my control in that other organization, to the detriment of the tax regime, basically, right? So that is where if the arrangement creates right obligation which are not ordinarily created between the parties, person dealing in the arm's length. So you create a certain arrangement, right, where now like which generally is not created between a when a party is dealing at arm's length. So somewhere kind of a special right obligation you get it. And what is that? It results directly and indirectly in the misuse or abuse of a provision of income tax, or lacks or deemed to lack of commercial substance in whole or part, is entered or carried on by a person in a manner which is not ordinarily employed for bona fide purposes. So this is called very vast basically essentially in this case, but this is called now like the case of a, we'll give you example also discuss with you, but this is called impermissible avoidance agreement, which now like can lead to the triggering of a GAAR provision basically. Like, so you create a sort of a agreement which now like leaves essentially a situation that the things are not at a arm's length. It means you take advantage of that proximity, or ultimately it leads directly into abuse of tax provision, or it lacks commercial substance, like so it's just for the purpose of sake of doing it has been done, or it is basically carried on in a manner which is not ordinary done basically, right? This is called the impermissible avoidance agreement. I'll give you an example to you. So the onus of like under GAAR to declare a IA is if the revenue consider, if the government consider the arrangement is IA, the assessee will be given a opportunity to be heard, and based on the response of assessee, further action will be taken. So assessee has to prove onus is on the assessee, and where there is no like suo moto GAAR applicable, it has to be specifically applied by the revenue by declaring arrangement as a, in that case the revenue can specifically declare a arrangement as a IA, as a impermissible avoidance agreement, and then again the like the assessee has to rebut it basically, right, where specifically declare that in this case. So let's take one case basically, like in one case suppose a business sets up a undertaking in an underdeveloped area by putting in substantial investment capital, carries out manufacturing activities there in underdeveloped area, you invest, you put investment, and claims a tax deduction on the such production manufacturing, whether GAAR is applicable. Now in this case, if you see this arrangement, and one of the main purposes is tax benefit, like in the you put in the underdeveloped area the industry, but this is the case of tax mitigation. It's not tax avoidance. Because tax mitigation, you are so here the revenue should not revoke the GAAR basically, right? There's no point of that. But if in another case you sets up a factory in manufacturing in the underdeveloped tax exempt area, right? And then from there you divert a production to other connected manufacturing unit. So it means you are manufacturing in the underdeveloped area, but then you divert certain production from this to the other connected manufacturing area where there is no benefit, and showing that it is manufacturing the tax exempt unit, right? So while only doing process of packaging there basically, so you only show it is manufactured in the tax exempt unit, right? So then it is wrong, right? So like it means you produce the good from some other manufacturing unit and bring to the tax exempt unit, do some packing, and then show it's been produced over there. Naturally, this is a perfect, this is a impermissible avoidance agreement. Right? Here agreement is because you are completely bypassing the law. Here the GAAR become applicable, right? And the government can, because you are now it's not a case of a tax mitigation, it's a case of a tax avoidance. So this is called a tax avoidance. You are avoiding a tax basically by that, right? So this is like not desirable, right? This absolutely. So this is the case of a. I hope you understand the GAAR basically, general agreement avoidance rules basically, which are like government can always invoke and check if something such kind of a things are happening in the as avoiding the taxes basically, right? So this is like about the first point, like which we understood about the GAAR basically, where like we should know, because that also used to bypass the revenue and using the now like for the benefit of the to now like ensure the government is not able to tax it. Then come another very important BEPS, base erosion and profit shifting. That again a very important concept which has come internationally, basically BEPS concept, like where mostly the multinational companies, like GAAR can be done even domestically, but BEPS involves multinational company. They employ the strategy to reduce the tax basis. Right? They employ this strategy basically. In this case, they reduce the taxes basically in such cases. So, how it is done basically? So, like in this case, this MNCs, what they does, like in like they are like, of course in the recently MNCs are developing some very sophisticated techniques to and tax planning to avoid taxes basically, shifting the income from one country to other country and to avoid to erode the tax base basically. So what is the, so there is a, that is why this concept has come with the BEPS, business erosion profit sharing concept. So and this has been basically now like essentially to start from the OECD, Organization for Economic Cooperation and Development. So is important international body, and OECD designed a 15 action point to tackle this is shifting of profit, the problem of shifting the profit, base erosion and profit shifting tactics which are adopted by the MNCs. So what exactly is the case? So like today, since the organizations mostly companies operate globally, and so it's very important, OECD felt that the government all work together to ensure that there is no misuse of the international tax systems and so on, and there's a fair competition. That's why like our G20, in our like where our country is heading. So like this forum can be used along with the OECD to ensure that that the effective implementation of BEPS, and it could really help the properly, like there's a lesser fixed deficit in the, because when the revenue comes there's a lesser fixed deficit, and there is a proper and strict environment will be there with respect to business, and the reporting requirement will be there. These are like OECD planned BEPS based on that, right? So what really basically for like exactly BEPS help basically in that case, the tax administrator now won't just introduce stricter measures and look for the restricting tax treaty benefit, but also test arrangement which in their view lacks substance or has a real commercial principle purpose. So what is that basically, the BEPS, business erosion, like and the profit shifting activity? In that case, the OECD recommended that the, it's not just we look for treaties basically, but you will look beyond that. You look certain arrangement which has been made by the entities, and if they lack substance, right, and or any real commercial purposes and has been just used for the tax avoidance, then they will look through that. Very clearly it also said like the enhanced transparency is one of the key objectives of BEPS, and this brings to a new reporting obligation, CBCR, country by country reporting. Each country will do the reporting, country by country reporting, CBCR, and based on that, like that the business increasingly would require track how changes to the transfer pricing practices, domestic laws, revised double taxation treaty would affect them. So like this the transfer pricing laws, the some of the domestic laws and the double taxation treaties, like we have to monitor
Excuse,
them
sir.
basically. Yes, yes, please ma'am. Yeah. Any
Sir,
question?
sorry to interrupt you.
Yeah, please,
Yes, sir,
please.
very sorry to interrupt you.
Yeah.
But that this BPS concept, can you please elucidate a bit further?
Yeah. Okay. Sure. Yeah. Just yeah. So yeah. So it is. I'm just giving you the initial point of the BEPS. See, the BPS is a basically a sort of a reporting mechanism which has been designed, and it is internationally it has been done basically, and it start with the OECD, like Organization for Economic Cooperation Development. There's a is there, and it is used to tackle this BPS, that this multinational company, because they employ strategies to reduce their tax base. So basic is the base erosion and the profit shifting tactics they use, but we will discuss little as you go further. Now exactly it's a just right now it's basically emerging concept. The OECD said very clearly, if the BEPS is used very clearly, then it will help in the nation shifting the facing the tax fiscal deficit, to help them. A strict environment will be there for the to focus on the business involvement, and the reporting requirement will strengthen. Now what exactly it says now, based on that, it says the government will be look for each country, will look for this tax administrator, where they will introduce stricter measures basically, right? This is a more of a theoretical right now. Stricter measure they were introduced to restrict tax treaty benefit, but tax treaty benefits are people taking basically. So to reduce that, they are not misused, treaties are not misused basically. And also we'll see various arrangement which many entities does, they have a clear now no lack of a substance basically, like this is the onus will be put on the tax administration in each country. This like OECD guidelines said. Also there will be enhanced transparency, like based on the BEPS objective. One is proper tax administration, then enhanced transparency will be there. And where this concept come country by country reporting, each country will be making the reporting, like CBCR, that reporting we'll discuss just now. And very clearly, like it also says that it will ensure to track the changes of transfer pricing. Like in our country, we have a transfer pricing, like how the changes in the transfer pricing are really is being properly tracked by the tax administrator, so that there's no misuse of that vis-a-vis domestic law. How DTAA, these are taxation treaties are there, because the two measures are there which are used internationally to about the multinational firm transfer pricing norm and double taxation treaty basically, like these two things are very very important. How really like in this case changes in this law, right, very clearly be tracked basically. These are just now. Let us go further. How in our country this is happening basically. Let us come to the BPS. Like India has been quite a vociferous in that involvement of the BPS initiative, and it is a part of the forum in devising action plan, and part of the various working groups, committees, task forces were set up for examining different aspects of these nations actions basically. So India, like very clearly they are following activity. So what exactly in our India is, it has some of these include implementation of that. One is country by country reporting. Like this India has been taken initiative at an international level. Each country will report what they will report. They will report on these things very clearly, like enhanced transparency over the key objective be. This bring now very clearly each country will report about the tax, how the tax administration is using stricter measure, how the implementation of BEPS, through that they will require complete track or the change in the transfer pricing laws and the double tax. This like each internationally information will be shared at a requisite form, like by the various each country. Then patent box tax regime with respect to royalty income. This is a very very major area, like in the internationally, like royalty income if you see. So royalty income, like many like is a normal areas are there, where suppose a company there's a publishing house in Japan, they publish the books. Now in India the same company take a copyright and take a copyright of publishing the books which are published in Japan by author over there. Now in India That company will publish the book, print the books based on that, and they will give royalty to the company in Japan. Now royalty, that the company may be related basically over there, and you can use the to divert profit from India to the Japan basically by paying the higher royalty, because in that case there is come the there is very clearly like patent box tax regime is there. So how really like various economies are having this kind of a now like now arrangement, and very clearly international arrangements are there which can be used to tax evasion basically, right? So like suppose this could happen like business erosion. Suppose I, like in my country, I use this aspect of now like paying the royalty to the to a company in Japan, and I pay higher royalty 50-60% like of the sale basically. So what I'm doing it, on whatever sale I'm diverting profit to Japan. So that can be done like very easily, very simple. Like in fact, one of my client exactly is doing the same way, and but we are keeping good control that they don't overpay the royalty. You are eroding you're eroding the tax base in India and sending the money in the Japan where taxes may be little lesser. So similarly, we have a concept, equalization levy which has come. That I think you must be aware. Equalization levy requiring withholding on the gross receipt basis payment, for payment for certain specified digital services as mentioned previously. It's a key contributor to the BEPS section. So you must be knowing that this happened equalization levy which has come in our country. Like the digital services are being given by certain like organization. Like suppose you are using there is a satellite is there, there is a company is there in USA which has a satellite link. You use that satellite link to upload your program, and which are watched across the world, but the programs are developed in India, right? So in that case programs are developed in India, and major like it is telecast throughout the world. The revenue may be at the various world level, and your company in India, maybe you are smartly not earning showing any revenue. You are only the company which is telecasting in USA is that is earning the revenue. So now the equivalation levy concept has come, where like certain, like based on your turnover you will have to pay certain thing. Even it has come now, on the e-commerce companies also, like e-commerce company in our country also are subject to equalization levy. This again based on the BPS concept. Now like very clearly, where like Amazon, you can see how Amazon is a US based company. Now they have an office in India and they sell the product basically. Of course they are sourcing from India, but Amazon can very easily erode the profits from India by like you can say the buying the, if they by showing the a sale on a higher value, right? Or by showing the purchases on a higher value from the like American company, and in India there will be hardly any profits are there. So they put a equalization levy where a certain 6% and 8% are there of the turnover they have to pay to the government as a minimum. So this has come as part of a BEPS concept, the equalization levy taxation concept which has come, which is there in the e-commerce company. So this is basically a very vast concept, BEPS. Through that, various measures are being introduced. Similarly, the CBC concept, where country by country reporting is there. There's the control of the royalty income is there. The equalization levy is there. So these are various aspects which has come now in this case, right? So I hope this BEPS clear about this aspect. Like I think someone is raised a question about this
Yes, sir. Yes,
BEPS.
sir.
Yeah. So it is a very vast concept which is being implemented like after GAAR another way by the with the internationally cooperation way, and this how like the various measures are being introduced by each country to ensure there is no base erosion and the profit shifting, like in case of e-commerce company I told you by royalty income, this kind of here, and then it has basically to has strengthened the various tax administration reporting mechanism. Then come the third aspect, POM, place of effective management. Very important concept. POEM, third measure again, which has been come now, which is again being used to erode taxes basically. Yeah. Give me 1 minute. Give me 1 minute. Yeah. Yeah. Sorry. I think there is a little, I think, problem. Yeah, please. So let me go further now. It's again a very important concept, place of effective management. Again, like after GAAR and after BEPS, this concept which has come and very strongly been introduced by the in the income tax by the government to avoid the tax provision misuse. So basically, it's a where the key management. What is POM? Place of effective management, where the key management and commercial decision that are necessary to business of an entity as a whole are taken. So this has come basically the POM where like mostly like the government has said ki where there is a effective place of management is there, that will be used to decide the tax residence basically, that will be used to decide the trigger of a taxation on an entity, not the where like exactly you show offices are there, but beyond offices the concept come place of effective management to levy the taxes basically, the sub the where. So what they will, and place of effective management is where the key management and commercial decisions are taken, that is where they are, right? So this is basically a concept which has come as a test of residence for the foreign company to provide that a company would be treated as a resident in India if the POM in the previous year is in India for. So even there's a foreign company, but if it's proved, of course we discuss that, the POM is in India, then it will treat as a Indian resident for the taxation purposes. That's a very interesting concept. Please understand that. So in that, government has issued the very clearly, but it is applicable, right? Very clearly now, like now to the company having a turnover of 50 crore and above, right? So so the not the small company, like they will not come under the concept of POM where the turnover is less than 50 crore. They will not come into that. So now what is that basically, right? In that case, so in this case, if you see, like it has come in 2015 by the government, and it is what we talks about that. Like if you see, like the section 6, many of you must be aware of the Income Tax Act deal with the residence provision, what the residence is there, and section 6 subsection 3 talks about that a company is said to be resident in India if any previous year, if it is an Indian company, and during that year, control and management of the affair is situated wholly in India. This is an old provision where, like, you are Indian company and the control and the management is wholly in India. But now it has been changed. It says you are an Indian resident and its place of effective management in that year is in India. Now we'll discuss about that. So from control and management, which was earlier by the situation, the government has made it to the place of effective POEM. That has been replaced because that is now benchmark, not control management. Now that of course we'll discuss what the effective management is. That will will go ahead. Now why this need come? Basically, like in this case, if you see again very clearly based on this concept by the OECD, they in the various countries the concept was there, and in our country also this has been introduced to align with the international standard, because internationally it is the place of effective management concept is there. So this bill was introduced in 2015 and very clearly it's been done, right? So now what is that basically, right? Now we'll go one by one. So the place of effective management guidelines, the determination of a PM depend upon the fact and circumstances of each case. Is a fact specific. There certain facts are there, and based on that, PM will be decided. The government says, right? And based on the guideline given by the CBDT, CBDT will issue a guideline, and the PM has to be done each year. Each year, PM has to be decided basically, right? And it's not he wants to decide because it may keep changing every year, right? This is a very interesting thing. And then, though an entity has more than one place of a management, you can have multiple places of management, but PM will be only one at a one point of a time. That's as per the law. We'll discuss that. But you can have a multiple place of management, like you can have a corporate office, you can have a head office, you can have a registered office. Many companies have, but PM will be one at a particular point of time, right? That that's something very, very important. So let's go further. Now, what is POM? It has basically, now in a way, some aspect which we need to consider for the POM. First is the about the POM. What's very important aspect we need to see very clearly is the active pace of business outside India, ABOI. So process of POM would be primarily based on the fact as to whether or not company is engaged in active business outside India, active business. Now let's discuss for that. Now PM of a company, such a company where active business outside India is there, would be presumed to be outside India if majority of the board of directors meeting of a company are held outside India. Now that's very, very, so you will be like, first aspect in this case is when you have a active business outside India. And active business outside India will be presumed in this case when you have the majority of the board meeting held outside India, right? So that is where is there. Of course, there is a bit confusion, like whether the majority meeting pertain to the majority meeting where key decision taken, or in total overall meeting. Because in some meeting, some key decision may have taken, some may not. So there is a little ambiguity there, but as of now, the people interpret based on the board meeting, because board meeting, it is all key decisions are there, but little still there is a confusion. Now this is one aspect when you have an active business outside India will be there, right? In that case, so this there's a one aspect will be used if your ABOI is outside India, and ABOI outside India will be there when the majority of the board meeting are conducted outside India. And if a company is not engaged in the active business outside of India, right? Suppose you don't are not are like you don't have business active business outside India. In that case, the PM will be determined, identify the person who actually make key management decision and commercial decision for the conduct of business as a whole, and determination of a place where these decisions are taken. So if a company is there is is not engaged in ABOI, it means there is no active business outside India. In that case, what we need to see, like the persons who actually make key management decision, like as a whole, and who are the person who take a decision, and determination of a place where these decisions are made, like basically, right? So this is like one aspect which has been talked about, the POM concept which has come in this case. And now let us go further. It's still not complete. Now, whether a company is engaged in active business, now what are the parameters are there? Like how you will decide a company having the active business outside India. So there are like four parameters are there. On that basis, like it is decide very clearly that the active business outside India, right? So one, of course, I told you, major is this majority decision, or that is in that case. But then, but this is like how to decide about the you are in this case active business outside India. Four parameters are there. One is its passive income is not more than 50% of total income, right? A company is said to be engaged in active business outside India. It company will be qualified ABOI where its passive income is not more than 50% of total income. Now, what is passive income? Passive income is somewhere you are earning not from operations, like you have a property income, have a rental income, right? There's not a there's a passive income. You have a fixed deposits, you are earning the fixed deposits. So this is not a, this is the, it's called a passive income. So in that case, what is there? What is active business outside India? Number one, if you have a passive income is not more than 50% of the total income, your passive income is less than 50%. In that case, one limb is that you can be considered active business outside India. Number one. Second, less than 50% total assets are situated in India. You are in India, your assets of the total asset are less than 50%. Then you will qualify as a. Now these are all together, please, not individually. These are all four conditions together, please remember. All four conditions to be met together to come to the ABBOI. One is your passive income is not more than 50% of the total income. It means you have a like passive income is less than 50% total income. Your assets are in India less than 50% total assets which you have. In India, you have a 50% less, 50% of the total asset in India. Thirdly, your less than 50% total employees are situated in India or resident in India. So your 50% of the total employees, less than 50% total employees, right? There in that case, now like are in India, situated in India or are resident in India. Then next one, fourth condition, your payroll expense incurred for such employees is less than 50% of total payroll expenditure. So all four need to be met. In that case, now like in this, so that in that case, the in this, so if a company settlement without if it's a passive income is not more than that, is so in that case, its asset is 50% less than like where if the where if less than 50 total assets are situated in India and less than 50% of employees are in India, basically less than that, right? In that case, you will consider active business outside India, ABOI. These are four parameters are there, like these four parameters are there which you need to meet, and along with that, this together, and along with that, this parameter, like along with this parameter in this cases. So if like in this cases, if you're like board meetings, like see one is please understand, this will make you qualify as a active business outside India. These four conditions. If your four conditions are met, you will qualify as a company ABOI. Number one. Then based on the if once you are ABOI, right, and in that case, if your board meeting, effective board meeting are outside India more than that, then your POM will be outside India, right? So this is the and if you now this is something very very important. So this is that like if you based on that you have to meet up this fifth condition also. Like in that case, if you are so it means in that case if you meet all these conditions ABOI, but if your board meetings are inside India, major board majority of meetings are in India, your POM will be in India, even if you are a company active business outside India. You are a ABOI very clearly, and in that case, you are as per the law, you are ABOI very clearly. But since your majority meetings are in India, board meeting, whichever key decisions are taken, your POM will be in India and effective management, and you will be taxed in India as your at a normal domestic company, basically, right? Very clearly. So this is something very very important to understand the concept of a ABOI. So I hope it is clear this concept to each one of you. So four condition will make you qualify as a ABOI, but then with the ABOI it will decide whether POM will be decided in this case of ABOI when you are basically now like what is the where board meetings are actually happening. If the board meetings are majority board meeting are happening outside India, you are a your place of effective management is outside India, and if the board meetings are happening in India, you are ABOI. you will be an Indian resident. So that I think is the point you must understand with respect to the ABOI concept, right? How this is being taken, and if you are not ABOI, like then this condition will apply basically. Then this will be very clearly like if you are not a ABOI, but you are key decisions, key management person as a whole, and the decision where you are taking that become the point. If you don't like become the AB or a part of a ABOI. So this is how the concept of POM will be cleared with the ABOI basically. So let us go further. Period to be now. What is the period for the ABOI will be taken? How the ABOI will be decided period wise? So as per tax laws, is the average of previous 3 years will be considered for the for the asset for salary. It's the average of 3 previous they need to be considered for the decide the ABOI because it involves, as I told you, about the 50% employees say payroll expenditure. So 3 year data to be taken basically. And if the company is not in existence for is there for less than 3 years, then for that specific period you can consider 2 year whatever the data. Okay. Now another point is there, if sometime company adopt different accounting year than from the previous year, like previous year in our country like the assessment year previous year is from the March to April, but many companies adopt accounting year different, like this sometimes they take a calendar year. So to clear in that case how to take care of this calculation of 3 year, the law said very clearly where they will take if the accounting year for the tax purposes is different from the previous year, right? So they have a accounting year, they follow the books. Then the data for the accounting year that ends up during the previous year and two accounting year preceding will be considered. Like for example, like you have to consider the for the assessment year 2019, the you decide the ABOI. So 2019 mean assessment year, previous year 1819. That we know very, very well, income tax language, right? So in that case, the accounting year ending in the relevant 2018 May. Up 2018 May accounting year will be ending, will be only calendar year of 2018. Only one that will be ending. Because that calendar will be ending. That will be taken plus average of the 2017 and 2016. So 3 year average will be taken, accounting average 2018, 17 and 16 to calculate very clearly this aspect of the this entire data to decide about the ABOI, right? So I hope it is clear to each one of you this aspect, right? Is it clear? I think because little complex, but the POM is a very important concept which you should understand. So this is how this is being functioning. So this is what is now if you go further in that case, like if you can see very clearly what are the consequence of the once your POM is in India. So if a foreign company found to be have a POM in India, in that case, like it will term resident as per subsection 6, section 6, subsection 3 of the income. You will become a resident in India. What is that in that case? Your entire global income will be taxed in India. Global income. Because resident income, if you are resident, whatever you have income, any part of the world, it has to be taxed in India. That is very clearly. Then, and the rate will be 40% applicable rate will be there in that case in this foreign company based on the POM. And of course, there are like other sections are there, section 115J, H, etc. are there, where like the taxation rate has been defined for foreign company with respect to royalty, with respect to other consulting income, interest income, etc. The rates will be governed for those like income as per section 115 JH for such companies, right? So this is how this PM now become a very important aspect to evade to stop evasion of taxes by the government now in the present cases, right? Okay. So I hope it's very clear to each one of you, right? And so this is where we need to understand this aspect of the evasion of taxes, how this is being taken care in this our country. So what are the penalties are there like how the basically now the tax evasion takes place in our country, tax evasion takes place, you hide your false hide income, you inflate reduction basically, you don't report cash transaction basically. All these various means are there, and penalties in that case are from 100% to 300% of a tax of on undisclosed income. This is why kind of a government has levied taxes basically. So if you see what are the common method of tax evasion, failing to pay the due. Very simple. You evade the taxes. You don't pay the taxes basically, right? In that case, you evade the taxes by willingly, and you don't pay the tax before the due date, right? And simple way, and then the government levy interest penalty. Then you ultimately are forced to pay, but you don't pay in time, right? To the government, failing to pay the like many kinds of tedious faults are there. We don't company don't file the tedious return. They clear the tedious. Now the laws are very strict basically. Failure to pay the due. Second way of is the tax smuggling. Certain goods you move from one location to another internationally and avoid excise duty, avoid the import duty. Right? Many company, very most of the company have import duty. Some goods are there. You clandestinely move the goods, smuggle the goods internationally, and avoid the import duties. Right? Then submitting false tax return. You submit the false tax return. You incorrect data, certain exemption you claim which you are not entitled basically, certain like expenditure you claim which you are not incurred. In a core financial statement you submit the wrong financial statement, like very clearly, so that also is a means to evade taxes. Using fake document to claim exemption. You use the fake document like deductions etc, claim exemption. You are a exemption from the like certain like certain society of exemption, like certain school of exemption, but like certain exemptions are there for the trust basically, but you are not properly approved. You claim the false document to claim the exemption from the trust provision of section 11 and 12 of the income tax act, right? So this way you do this, you have a submit the false documentation, like so. Similarly, you do not report certain income, right, at all, or you bribe, right, in a situation when to the official to avoid that being caught. Finally, penalties basically, what penalties are there? Like penalty I told you is 100% to 3% of tax when the income is not disclosed. Very heavy strict penalty are there, and like in that case, in case you don't pay the taxes, the officer can really now like levy the heavy penalty. In case of a like that and tax I told you penalty goes to and 200% or 300%. Then similarly, there's a books of account if you don't maintain, there's penalty of 25,000. If you don't get the report from an accountant, right, tax audit report, you may be levy a fine of a 1 lakh. So multiple penalties are there. So this is how like you can see the various provisions are there of this thing. Yes. So we can take a break over here, I think. So before I go to the next, but if any question you have, because this topic was a bit I think quite multiple issues were there. If you have any issue, I can discuss right now. Please feel free to ask. Like I can address those issues just now, and otherwise we can take a break for a 5 minute. But if you have certain issues where you feel I have skipped, I couldn't, I need to re-explain certain facts, so I can do it before we take a formal break of a 5 minute before we take the last chapter like of this session, of this module rather. So yes, any question you have, anything, so please feel free to ask, so I can really answer, or anything you want to discuss basically. You have certain experience also, you can share also over here, so somewhere. So please, you can always share over here. Yeah, please, yes, anything or any clarification if you feel. We have discussed GAAR basically, then BEPS, then POM, multiple issue we discussed, and how really these are measures used now like by the government to stop the misuse of tax provisions basically, right? Yeah. You joined the yesterday. how can I get the previous class shared document? See, documents, Raghunandan ji, my dear friend, like PPT, I can share. I think I have shared already, but I can share the PPT today. So PPT you can read is no problem. There are, so we have shared the PPT case study. Anyway, I shared yesterday in the group. You must be part of the group, which like WhatsApp group. All the students they have created. So there I have shared the case study which we have discussed yesterday. Their answer, and even today's case study I have put over there. So you must have received PPT. I believe I shared, but if not shared, I'll share today once again. So that way you can just now like be on board with us by reading those material, like essentially. So I think you will not be lagging behind. Don't worry. Yes. Yes, sir. Any other question? Anything? If you have something, then I can discuss over here. Yeah. Okay, I think then we can take a break of a 5 minutes and then we'll meet, join together once again. Yeah. Okay. Thank you. So we are starting the session now. So we'll take up the last chapter, and which is again very interesting chapter. We'll just take up the is there. So forensic audit application of mathematical quantification. Is my slide visible to you? Just anybody confirm to me? Is my
Yes, sir. Yes.
slide
Yes, sir.
okay?
Yes,
Forensic
sir.
audit application of mathematicals. Very interesting aspect is there. So here we'll discuss something very very important. There is a law called Benford law. Anybody has listened about the Benford law? Anybody of you have listened? What is the Benford law? आपने कहीं अपने practice सुनाओ? Yes, Mr. Pradeep. Yes, Pradeep said he said yes. Okay, what is that? Can you explain that, Mr. Pradeep? Anybody? Yeah, have you used somewhere? What is that? Is law Benford law? If anybody aware of that, प्रदीप जी ने सुना है हमारे दोस्त ने. So if somebody, if you can, yeah, Pradeep ji, if you can, you unmute yourself and speak something. Yeah, anybody else? What is that law? Any of you? Benford law. Yes. I think Pradeep ji may have only listened but not aware of that. Okay, okay, don't worry. I'll explain. So let's go through that. I think it's a very interesting law. It's basically a very interesting law, and of course, practically we'll do in the some future session. There's an idea software is there where you will be learning. And on Excel also, I think we'll be doing it. So I think that will be taken care of that. So, but what is that basically? Let's understand this about the Benford law. Like usually, like if you see the mathematics, it's a mathematical law, and in the mathematics, is basically like we have a pattern, relationships are there, and similarly, like the forensic accountant also use mathematical techniques, a very complex business financial techniques we use to discover a fraud basically. And one of the major important concept is the understanding of mathematical randomness. Randomness basically, right? So how there is a in a mathematics some data behave in a random way, right? And then we see like very clearly now, like essentially now like uh, in a mathematical way, and in that case we check whether the data is as per the random range or not basically, right? So the certain data works in a certain random way basically, right? And that is done where like we use this Benford law. It is called computer assisted audit tool, CAT tool, and very very famously used like in the worldwide. It's called Benford law. What is the Benford law basically? This is basically devised by Mr. Frank Benford. He's a very famous physicist long back in 38. He came out with a mathematical theory of a leading digits, mathematical theory of leading digits specifically, and the leading digits, and they said very clearly said the leading digits behave are distributed in a non-uniform way. In any data, the digits are distributed in a not a uniform way. Like he said while One might think number one would appear the first digit, like at 11% or whatever may be the. Actually, as per the research, the number one appears around 30% in a data, and 9 appear less than 5% in a data. So this theory covers the about the appearance of a data, right, as a first digit, first two digit, right, as a second digit, and last digit. Whereas combination Mr. Benford made, and based on the logarithm theory of the probability of occurrence of digits. So he went with the probability of occurrence of digit, and this was the prediction he made basically. Now this was the prediction if you see, right? So somewhere he said, now look at the prediction. He said the number one, if this is will appear around 30%, like in a database as a first digit. Number two as a first digit will appear around 17%. Number three, 12%. Four, 9%, so on. Now, this what he described these 1 to 9 digit as a first number in a database. This is the, like he gave very clearly the probability of occurrence of digits basically, right? So about the first digit which he gave, of course he give a probability on the first two digit as a second digit, but this first digit we are seeing this one, and he said if the data do not behave in that way, there is a possibility the data may have been tampered basically. There is a possibility data may have been tampered essentially. So this is what is used the Benford law about this. This is the very clearly said the probability of occurrence of digits about the as a first number, right? So like in any database. Now, so and this has been applied in a number of at various level to check, and it has been found is working. Like there's a one case which has been done, like in this case, example of a Mark Nagrin research which showed Benford law could be used as an indicator of accounting and expense fraud. And one fraudster wrote numerous checks to himself, like in a company, a fraudster wrote numerous checks to himself, but below the 1 lakh USD, right? The policy threshold. And he used the digit 789 because he don't want to use the 1 lakh, which was the threshold limit, less than that. And by that, what is happened? The 7, 8, and 9 appear quite a more like about the percentage now actually predicted by the Benford law, and they were essentially now able to now find committing the fraud very easily because their digits were not complying the Benford law of the probability of occurrence of the digit, because they were at a like mostly checked were issued 7, 8, 9, and in that case naturally like the percentage goes up like 7, 8, 9, if which the percentage is 5.8, 5.1. These are normal, like I said, in a big database, this can be the percentage by this data will occur. And similarly, like in one more case, in the you can see like in the analysis also was used in the Iranian election, and where it was found basically there's a evidence of fraud was there. So like there are various ways are there like this how this fraud has been like committed worldwide, and so this way it can be used to detect a fraud like when the data do not behave in a particular way. I hope it is clear to you the first vertical aspect to each one of you. If anything not clear, I can re-explain because the very important concept. Of course, practically you will be doing the future session. We have like a idea software which allow this Benford law to be used. You can use, and in fact, I have already wrote to your directorate to permit I think some sessions on the Excel also, where some critical technique of Excel also we learn. So we will be like I've written to them I think. So maybe I think once it is there, we will do some technique. You're learning Excel technique also to detect a fraud basically, right? So this is what has happened basically. This is like essentially this is used, and this very clearly like this fraud detection technique has been used. Now, where this benefit law applies as analysis, like maybe in credit card transaction, purchase orders are being issued, loan data, customer balances, journal entries, stock prices. account payable transaction, inventory prices, customer refund. All these areas are there where benefit law are applied to analyze if the data do not behave in a proper way. They consider very clearly that there is a fraud has been or data has been tampered, right? So, but somewhere this data is not suitable, like airline passenger count per plane, because there like the like data is depend upon the capacity of a plane. So that way, like it doesn't fit. Telephone number, like telephone numbers are issued in a very systematic way, so they may not behave. Like where the data is very lesser, like 500 below that is very less data, then it will not be very appropriate. Yeah, data generated by numbers, yeah, like insurance policy numbers mostly generated by a some kind of formulas, it will not behave. Or where the data restrict by the certain like maximum or the minimum hourly rate, so it will not behave properly. In that case, these are not the like the because this here data is not is lacking randomness. So that is there now. Now there are like some assumption or constraints are there with the benefit law, which we need to remember. The data should be numeric, not the alphabetically alphanumeric. The number should be randomly generated. They should not be restricted by the maximum or the minimum limit. They should not be assigned a number, and the data should be large basically, very very clearly, right? And so that way, like you can see then only like this will applicable these cases. So what further what constraints are? It's important to note the one assumption when for law the number in large data should be there very clearly. Data should be large basically. But like I told you, in case of a hourly wage rates are there where the rates are fixed, then it's not like essentially will not be like benefit law will not be applicable. The telephone number which are issued in a systematic way, so benefit law will not be applicable. So that is how like we should understand. So these are some constraints are there which benefit law like has to be like very well taken care. So this way, so the benefit law basically recognize the probability of highly likely or highly unlikely frequency of number of a data in a data set, right? Very clearly. And they are based on the mathematical logarithm and the way and the occurrence of how the digit will occur in a randomly data should be randomly generate data, not the like in a specific generate data like telephone number or the wage rates basically. In that case, very clearly now, like you need to. So, of course, as an auditor, you should remember this assumption, and based on that, you should be able to take up this, understand the benefit law. So, of course, practically we'll do it in the, I think you will all be doing the future session, but this how this benefit law. So this is where like we are able to, we are at the end of this chapter, module 9, module 1 basically, and the chapter 26 basically, right? We have completed this benefit law. Yeah. Any question is there now? This with this completed module 1 in totality today. We have done it now. So any question you have, any impression, then we can take up the case study which I sent you yesterday, right? We can take up that also. But any question or anything, or the benefit law which we just I shared with you, if you have anything you can ask me. So if not clear, of course practically when you use you will appreciate it more. That is something very very wonderful. But right now, which I explained to you, I hope theoretically is clear to you, and you are able to comprehend it. And I really feel like in the future when you learn, you can use it, incorporate this as a very important tool to detect a fraud basically, right? Yeah. Yes, anything, any question you have any on this benefit law? So you can ask, or even previous chapter also we discuss the GAAR BEPS. So or any impression you wanted to have, yes, please feel free, so we can discuss that. Yes sir, any point please, so you can always share with over there, so we can quickly discuss those things. And yes, if any specific issues are there, so please feel free to, I can take up that. Okay.
Sir, one
Yes
thing.
ma'am. Yes.
that how we are going to apply the Benford's law in detecting the fraud, sir. That is, can you please explain?
Yeah. See that. See, one is the Benford law talks about there is a data do not go as per the probability of the numbers. And if it does not go, it only give an indication. Then you have to do investigation further, right? So that is what. So like I give you example, like this one of my friend has done it, like in a cola company, he has done the same thing. Like in a cola company, the basically the bonuses are given to the distributor, to the like to the agent and to the shopkeeper based on the movement of how many crates are being like sold basically. So the moment of crate is the benchmark to get a bonus, not the bottles. So many like few years back, this fraud occurred in a cola company in India. Like they what they did it, they instead of like some distributor, when the empty crate comes back to them from the shopkeeper, they again show the amount of empty crates because the bonus was on the crates movement, not on the sale of bottle. So the empty crate they moved and claimed a bonus basically, right? Now and this has been happening. So this one of the person who was very in an account department, he applied the Benford law over the figures of bonus, over the figures of the this crate movement basically, and then he find that the crate movement figures are not following the Benford law, right? Very clear the prediction. Now, but that is only an indication. Now, Benford law is given that the randomly probability theory is not following the data is not following the law. But what is the background, how this has occurred, that's a matter of investigation. So he has to do investigation for the next 2 months. Then he ultimately come to the very clearly find there is a reason behind. So Benford law will only give you the a first an indication, but rest is a matter of investigation. How, why, in what way the fraud has occurred is a matter to be investigated by the forensic auditor. They only give an indication that there is a data is not following the probability of the figure which has been predicted by Mr. Benford. Right? It did normally the data should predict as per his like he analyzed billions of data analyzed. So, like similarly in your company, if the sales data is there, you can just import the sales data and analyze it whether sales data complying with the Benford law. Like the first digit is there around 30%. All this you can see. And if it's not there, then it means somebody has fudged the data. Now, how, when, and in which way? That's a matter of investigation. When Mr. Benford law does not give you the further clues, only give you the first point that the data is not following the protocol, right? Then rest you have to investigate, right? So this is how this Benford law need to be understood and applied in our life. So I hope it is clear to our friend this point. Okay.
Absolutely, sir.
Yes. Any
Sir,
other issue on the
sir, I
Benford law?
have
Yeah.
a question.
Yes, please, ma'am. Please, please.
Sir, this we are telling that Benford law will be using randomly generated numbers. Is it similar to the statistical technique of Monte Carlo simulation, sir, using random numbers?
No, no. See that. Please understand. Monte Carlo simulation technique is a bit different here. Here, what really like this Benford law, it functions based on the presumption. The run systems are randomly generated. It presumes that, right?
Hmm.
It presumes that the figure which I am analyzing, which system analyzing, is randomly generated. They are not like any like we discussed just now in the lecture. Like suppose in a company the hourly rates are fixed. They are somewhere defined hourly rates. Hourly rate will be between $100 to the $200. So in that case, naturally, the figures are not randomly being generated. So the Benford law will not will have a constraint over there. Like similarly, if you have a telephone number being generated allotted to the telephone allottees, so the telephone number allotted in a very specific sequence number. So Benford law will not be applicable. Benford law
Hmm.
applicable to a randomly generate number, and based on that they make a prediction. In that case, the probability of occurring number 1 as a first digit in that randomly generated data, which should be above minimum of 500 and above, is around 30%. Probability of occurring number 2 as a first digit in a randomly generated data is around 17 to 18%. This is what Mr. Benford predicted. And that is way, like, and if he says if the prediction is not, if the data is not as per this prediction, somebody has tempered the data. Now, how, why, and when, that is the matter of investigation. This what is there. So it already works on the randomly, like the presumed data is randomly generated as per, there's no control otherwise on the data. And he said based on that, a large population of data will behave in such a way where number will occur around 30%. 2 will occur around that percent as a first digit. And this way he predicted, did the prediction of other like digit also, like second digit, first 2 digit, and so on basically. But we are discussing specifically in the graph I show to you only one number, 1 digit. So this is what is there, like, so which talks out very clearly about the, like, the data is basically, it says the data should be come out randomly, and in a random way it will have this kind of a probability appearance of digit, basically probability of digit. This is what he said, like this, right? So I hope it is this what the is the hypothesis of this entire theory of Benford law, right? Yes.
Okay, sir. Thank you,
Yeah,
sir.
Mr. GSK Verma raise hand. Yes, sir. Please, you can ask question, sir. Please. Yeah.
Yes, sir. Sir, practically, I don't know how this Banford law is used, but I'm just thinking loudly, sir. Say, for example, the sale prices of the goods is, say, for example, 999 instead of rupees 1000. So in those circumstances, we have the price of 999 and the collection will be either 999 or near to that maximum figure. So how in these cases, if fraud is detected, because it is not a random number, so how it will be used, sir, in these cases? Because this is not controlled. I mean, it's not natural numbers. It's like controlled environment. Like price is decided on some basis, maybe 555, 777,
Yeah, I'll
like
tell you.
that.
I'll tell you. See that in that prices, of course, in every organization are controlled, but quantities are not controlled. Prices are multiplied by quantity, and then the sale value come. So that is, the quantity may differ from situation to situation. Somebody buy maybe 1 lakh, somebody buy maybe 20 number, 30 number, 100. So the that is where the this will we need to apply on the sale price, not the quantity. Like I have seen in many cases people applying on a total sale value. Like if there's a sale data is there with you of a 100,000, 2,000 devices data is there, you can, and you can apply Benford law on the sale value, which is, of course, price is normally is always governed in an organization, but quantity is not governed. Basically quantity is depend upon the buyer. So that way, like on the sale value, we very well apply this Benford law on the value, not on the pricing, right? The constraint will apply like when basically the somewhere wage rate are specific, like wage rate are specific in certain range, but prices of course are fixed. But prices multiplied by basically on the values, like essentially, because pricing naturally has to be governed, multiplied by the quantity. In that case, the data will be random, right? Because some people buy lesser quantity, some people buy more quantity, and then the values of a sale on that sale value, if I apply Benford law, right? And in that case, like if I seek this, if the data aberration is there, there is a probability that the data has been tampered with. This one, Mr. Benford law. So
Okay,
this
sir.
is a,
Got
so
it.
I hope it is so. Of course, practically in the future we have case studies. You will be doing it, but this how this Benford law we apply on the sale value, and when see it behave in that way or not. Okay. Yes. Another question. So of course, like to tell you very frankly, this Benford law in the first, like when even I listen, I find bit strange. because we're all like are the commercial people are there, but it is very well accepted in the world and applied in a number of situations like you can see. And and you will see that. That's why I really feel you should apply it. But of course, just wait when you go for the actual use of a software in the future sessions, then you can see that. Yeah. Yes, any other question on the Benford law, or any other point which you wanted to share or ask? I think we can very well discuss. Yes, please feel free. Any point which is you want to clarify. Okay, sir. Then I think then we can go for the case study. The case study which I shared with you yesterday, I think, which you must have gone through, but we can just sharing with you where we can read together the case study and then we can see the answer also. Yeah. Okay. Yeah. Just a minute. Let me open the my slide. So this is a situation now. Yes, sir. So please share what is in your sense is the fraud where we went basically. Yes. Please share now. Any of you can unmute. I hope you've gone through the case study. Where is the problem now? And yes, what is your business sense says about this fraud? Yes. Any of you, please unmute. You can talk and you can share in the chat box also. Yes. Yes, sir. Please, each one of you, where is the problem now? There is a problem definitely, but how do you reach to the bottom of the point? Where is the in this case? Who is the culprit basically, and how this modus operandi is being followed now? Yeah. Okay. Yes. I'm just waiting for your replies and where like the things have gone and who are the main culprit, like as per your understanding. Who are the main culprit?
Sir,
Yes.
it looks
Yes.
like the distribution manager in the distribution department because the fraud has arisen there.
Okay. So distribution manager is the culprit. Okay. One finger has been pointed to that person. Okay. Okay. So what else? Who else can be the person? Yes. Who else? Anybody else? Like where do you feel is this problem is there? Yeah. Yes. Use your experience of your corporate and otherwise. How like you feel the fraud is there? Anybody else? What is the answer you have now on this case? Yes, sir. Please reply that. I hope you have understood the issue and very well able to see the problem. Swan, of course, our friend has answered ki the distribution manager. But anybody else, do you feel the culprit in this problem? Who has done this, committed this error? Yeah, not really. Okay. So let us see the answer then. Let's see the answer and then we'll see that who is the main person. I'm showing the answer to you. Just 1 minute. Let me open the answer for you. Yes, so let us read that now. I'm just opening the answer for you. Yeah, please read each one of you. Just 1 minute. Yeah, okay. So I just shared with you. I hope my this screen is visible to you now. Just anybody confirm to me is visible. What is the nature of fraud and how it was committed? Is it clear to
Yes, sir.
you?
Yes, sir.
Okay.
Visible.
So please read
Yes,
that.
sir.
Please read now and enlighten yourself how these things are happened. Sorry, I just logged out by mistake, I think. So yeah. So that is yeah. I'll share the PPTs to Rajamani. I'll share the PPTs. I think just don't worry about that. I'll do it that way. Yeah. So yes. So any question? Otherwise, we can just so this complete your chapter of so model one chapter which is there. Through that we are through that, and you can just go through and do it. So we'll see in the about the like how the in the model two will starting in the coming weekend. But this is what all we need to share about the module one, right? So if there's no question, I think then we can just wind it up in that way, the session. And thank you very, very much to each one of you and wish you again a very, very happy new year. So please
Thank you
take
very
care
much.
of yourself and please have a wonderful week ahead, right? So let us keep like moving ahead and with a fresh determination in the new year. Yeah. Okay. Thank you very, very much, sir. So I'm just logging off now. Thank you. Thank you very
Thank
much,
you,
sir.
sir.
Thank you. Yeah.
Thank you, sir. Good night.
Thank you. Thank you.
Thank you,
Good
sir.
night. Sir. Thank you. Good night. Good night to each one of you. Thank you.
Thank you, sir.